In this video, we are going to discuss about basics of accounting. That is mainly about accounting principles. Actually, we should have a thorough knowledge of these concepts because nowadays UGC net asking you continuously concept-oriented questions. Okay. So what is accounting principle? Accounting principle is generally a guideline, or it is actually a rule or regulation that actually gives you an idea of how to record transactions. Okay, so why we have such a rules or regulations? In order to have a uniformity in the preparation and presentation of financial statements. Okay, so that is actually we are saying it in a generally accepted accounting principle. It is generally accepted by professionals, that is accounting professionals. So before going to the topic thoroughly, we can just have a look on some questions asked in exam. Okay, so this was a question asked in December 2015. Dual aspect concept result in which of the following accounting equation? So this is about dual aspect concept. This is one of the accounting principle, and here we have different equations. So which equation is actually possessed with this dual aspect concept, that we will discuss in detail. Okay. Another question is an assertion reasoning question that was asked in July 2018. That assertion is given as personal transaction of owners of business are not recorded in the books. The reason is given as according to the business entity concept, each business enterprise is considered as an accounting unit separate from the owner. So this is about business entity concept. This is another important concept that we are going to discuss in this chapter. So we will look at it. Okay. So now the generally accepted accounting principle has major two classifications. The first one is accounting concept and the second one is accounting convention. Accounting concepts include separate entity concept, money measurement concept, going concern concept, dual aspect concept, realization concept, cost concept, accounting period concept and matching concept. While coming to accounting convention, it includes conservatism, consistency, full disclosure and materiality. So we are going to discuss about each of these concepts clearly. Okay. So first of all, what is accounting concept? Actually, accounting principle is categorized into two, that is accounting concept and accounting convention. So first we are going to discuss about accounting concepts. Accounting concept is actually an assumption. So that is a basic assumption, and based on that assumption we are recording transactions. So for recording a transaction, a particular business transaction, there are certain things that you have to keep in mind while recording those transactions. Such basic assumptions or such basic rules are actually coming under this accounting concepts. So this actually guide you that how you have to record a particular transaction. So it is actually considered as a guider. That is, accounting concept is mainly considered as a guide. Okay. So the first important concept is business entity concept. It says that business has a separate legal entity from a part of its owner, that is both the owner and the business. It is both of them are different person. Okay, both of them has separate legal entity. Each of them is distinct from the other. The concept assumes that business has a distinct and separate entity from its owner. When a person brings money as capital into his business, it is treated as a liability of the business to the owner. So we know that when a particular, that is when the owner, he brings cash to the account, that means when he is investing an amount in his business, that is actually considered as capital. Okay, so this capital is the liability of business, that is the business have to repay that amount to the owner. Okay, that why we are saying that, or why we are actually recording capital in the liability side of balance sheet. This is actually because of this concept. What is the reason? Actually, the business and the owner, they are two separate legal entity, and the business is liable to pay back the amount that he invested, that the owner invested to the business. Okay, this is actually because of this concept, that is business entity concept. Now, next important concept is money measurement concept. This concept says that all the transactions which can be recorded or which can be monetized, okay, so such transaction will find a place in the books of accounts. So transactions should have a monetary value. Actually, think about a thing that's happening in a business. So if a particular employee has such a creativity, okay, but we are not able to monetize his creativity or intelligence in monetary units. isn't it? We can't say that a particular person has 500 rupees knowledge or 1000 rupees knowledge. We are not able to monetize those values. So in such cases, we should not find a place in the books of accounts. Only those transactions that can be monetized, that has a monetary value, will find a place in the accounts. Okay. Only those transactions and happenings in an organization which can be expressed in terms of money are to be recorded. That is, capability or creativity of an employee do not find a place in the accounts. So why it does not find a place? It is actually only those transactions which has a monetary value find a place in the books of accounts. Now the third important concept is going concern concept. So this concept assumes that the business has a long life. So we know that everything that we are doing with a basic that okay, it will have a long life. Okay, we are assuming that tomorrow we will be there. We are actually in our life also we are planning loads of things that what we have to do after 5 years, what we have to do after 10 years, isn't it? Like a way that business is also assuming that it has a long period, it has a long life. That is actually discussed in going concern concept. A business firm would continue to carry out its operation indefinitely. That is, it has a long life. Okay, the lifespan is, it has a long lifespan. Okay, for a long period of time and would not be liquidated in the foreseeable future. It is not going to liquidate in a near future. It is carrying on. Okay, it's going on. That is, the business is going on. That's why it is named as going concern concept. Okay. Now another concept is accounting period concept. This accounting period says about a particular period, okay, a period within which we are preparing the financial statements and all. So actually we know that the business has a long life. We have to divide these life periods in order to have a better idea of each period. Okay, so such a way, why we have to divide that? Because at the end of that accounting period we are preparing financial statements, and with this financial statements we are able to know the profits or the loss that business earned within that particular period of time. Okay, so the span of time at the end of which the financial statements of the enterprise are prepared to know whether it has earned profits or incurred losses during that period. So actually it goes from 1 year. Okay, now the current accounting period we can say that it starts from 1st 4th 2022 and that ends in 31st 3 2021. So it starts from a particular year, 1st of April, and that goes end by 31st March of the next year. Okay, that is first the current accounting period is 1/4/2020 to 31st 3/2021. Okay. Now another important concept is cost concept, and it is also known as historical cost. Okay, so you should be very aware about the different names of each and every concept, because sometimes they will ask you questions with the different names. Okay, so you should be aware. Okay, if in the questions in the option the different options is given based on the other name, you will be confused. Okay, so you should have a thorough knowledge of the different names of each and every concept. So now we are discussing about cost concept. It is also known as historical concept, and this concept assumes that all the asset, the value of the all asset should be recorded at its purchasing price, and this purchasing price should include the transportation cost or all other costs concerning to that particular asset until we are making it ready to use. Okay, that is, if we are purchasing a particular asset, we have to pay amount at that shop, isn't it? Then after that we have to transport it to our factory or our enterprise. At that time you have to make a lots of, you will incur a lots of cost. All these costs should be included in the value of asset. Okay, that is actually considered as the purchasing price. Not only the price that we made for acquiring that asset is not only included, it also includes all other expenses related to that particular asset until make it ready to use. Okay, so all assets are recorded in the books of accounts at their purchasing price, which includes cost of acquisition, transportation, installation and making the asset ready to use. If you are purchasing a asset for, think that if you are purchasing an asset for rupees 5 lakh and you have to make a transportation cost of rupees 20,000. So you you have to consider the cost of that particular asset as 5,25,000. Okay. Now, dual aspect concept is a very important concept from the from considering the part of different concepts of accounting. So, dual aspect says that every transaction has a dual effect or double effect. That is, every transaction has a twofold effect. Okay, that is, when we are considering each and every transaction of business, it has a debit and a credit effect. Okay, both debit and credit effect. Think when we are firstly we are recording transaction starting from journalizing. So, journalizing starts with a particular entries. Okay, if you are just consider a cash sale is made. Okay, what is the entry? Cash account debtor to sale. So, debit and credit both will come in every transaction. There is a two effect, double effect. Okay, that is a debit and a credit. Okay. So, based on this principle, this equation was given, that is asset is equal to liability plus capital. Okay. When we are looking to the balance sheet, you can see that on one side we are writing assets, and on the other side actually liability and capital is recorded. And why actually capital is recorded in the liability side, that we already discussed in which concept? Business entity concept. And this equation we saw this equation in a question. Okay, so that we will discuss. Now, just consider an example. Ram started business by investing in a sum of rupees 5 lakh. The amount of money brought in by Ram will increase the asset, that is cash, by rupees 5 lakh. At the same time, capital will increase by the same amount. Here Ram wants to start a business, and for that purpose he invested rupees 5 lakh. So, this 5 lakh, when he invested this 5 lakh, the cash, okay, cash we know cash is asset. So, cash will increase by rupees 5 lakh. At the same time, on the liability side, capital will also increase by rupees 5 lakh. So, see that it has two effect, okay, that it can be reflected in two sides. Okay. Now, that is about dual aspect concept. So, dual aspect concept mainly says that every transaction has a two effect or double effect, and that is credit and debit effect. Okay. Now, revenue recognition concept or realization concept. So, what is this revenue recognition or realization concept? Revenue for the business transaction should be included in the accounting records only when it is realized. Okay, you have to record a particular transaction only when you realize that particular transaction. Okay, when you realize the value, at that time only you should record. Okay, before that there is no place, or there is no need to record in the business accounts. Okay, so here is an example. Credit sales are treated as a revenue on the day of sales are made, and not when money is received from the buyer. So, credit sales, when a credit sale is made, we know that we are actually not getting money from that particular buyer, but we know that we will get that money, isn't it? Because it is a credit sale, we sold on credit, we will get that amount in a future date. But when this credit sales happen, at the same day we should analyze that, or we should understand that amount we will realize. So, credit sales are treated as a revenue on the day of sales made. So, when the sales made, at the same day you have to analyze that, or you have to understand that amount is realized. Okay, so you have to make the transactions in the accounts on the day when credit sales happen, not when you receive the amount from the buyer. That is actually seen here. Okay, so this is about revenue recognition concept or realization concept. Now, another important concept is matching concept. Matching, there should be a match between revenue and cost. That is actually in this concept. It states that expenses incurred in an accounting period should be matched with the revenues during that period. So, in a particular period, we know that we are incurring expenses and revenues. So, we should get matched with both these. Okay. So, the revenue should be matched with the expenses of that particular period. So, here the best example is depreciation. As we know that we are getting income, or we are making lots of income from a particular asset. Okay, we are using the asset to make our output, and we are getting revenues. In such cases, we know that asset get depreciated period over period. Okay, in such cases, depreciation should also be recorded in the business. Okay, so it should be also recorded in the books of accounts, because every time it is also, whenever we are making revenue from the asset, then also actually the asset get depreciated year by year. So, it is very important that you have to record depreciation. Okay, because it is an expense, it is not a cash item, but even though it is an expense that actually happens. Okay, so you have to record depreciation. So why you have to record depreciation as an expense? This is because of matching concept, because you are you are getting revenue from the usage of the asset. Okay. Now we are going to discuss about accounting convention, that is another categorization of accounting principle. Okay, so what is this accounting convention? Accounting convention is it is a generally accepted practice. Okay, that is generally accepted by accounting professionals relating to how you have to record particular transactions. Okay, so it may be defined as a generally accepted practice which is adopted either by general agreement, that is by the general agreement of accounting professionals, okay, or by a common consent among the accountants. Okay, with the consent of accountants, we are actually giving this accounting conventions. Okay, so there are different accounting conventions, we are going to discuss about that. Before here we already studied about accounting concept and accounting convention. So what is its different? Both of these are a kind of accounting principle. Both of them are two categories of accounting principle. So what is its difference? Accounting concept are established by law. So it is established by law, that is which is enforced by law. You can't change, you are not able to change it. Okay, but accounting conventions are guidelines. It actually guide you that how you have to record a particular transactions. So accounting convention act as a guideline, while accounting concepts are law based. Okay, it is enforced by law. That is the main difference between accounting convention and accounting concept. Okay. Now we are going to discuss about each of the accounting conventions. So the first one is consistency concept. The term itself says that there is a consistency. So what is this consistency? There are different practices we are actually following while recording accounting transactions. So there must be a consistency over this. That is, if you are practicing a particular thing, here we have an example. Let's take this example to make more clear, that is depreciation. We know that we are calculating depreciation every year. For calculating depreciation, there are different methods like straight line method, diminishing method, and there are different other methods. Mainly we are focusing on these two methods. Okay, so we can find this depreciation based on any of these methods. But when your business is using diminishing method, you have to follow diminishing method in the future period also. You are not able to change in year by year. That is, this year you are following diminishing method, then the second year you are using straight line method. It is not allowable. Okay, you have to follow a particular method. Okay, you have to follow whatever you want to use. Okay, whatever you used in the first year, you have to continue with that itself. That is actually consistency. That is, there should be a consistency with the practices that we are following in order to maintain a uniformity. So accounting policies and practices followed by enterprise are uniform and are consistent over a period of time. So that should be consistent, that should be uniform one. So whichever practice you are following, you have to follow that continuously. You are not able to change it in different years. Okay. So this is very important in order to have it will help you to have a better analysis in the future period. You can make some intra-firm or inter-firm analysis. In such case also, it is very important that you should have a consistency in your accounts. Okay. Now another important concept, there are many questions asked from this particular concept, and the option was given as prudence. So when you study only this conservatism concept, you may not be able to answer this question. Okay, so you should be aware of the other name, that is prudence. So the name of conservatism concept is prudence. What is this conservatism concept is all about? It provides guidance for recording transactions in the books of accounts and is based on the policy of safety. So it is actually based on the policy of safety. What is a safety? Which means that you feel that, or you know that there is a chance for profit, or you feel that there is a 95% chance for profit, but you should not record that. But you find that there is a 5% chance for a particular loss, you should record it. Okay, so whenever you find a remote possibility, even if it is a remote possibility, even if there is a remote possibility for a loss, you should record. But you find that there is a huge chance for making profit, you should not record the transactions. Okay, you should focus on loss even if it has a remote possibility, that is, even if it has a lower chance. Okay, profit should not be recorded until realized but all losses, even those which may have a remote possibility, are to be provided for in the books of accounts. So, profit should not be recorded until realized. You should record it only when you realize, but loss is not like that. You should record it before realizing it, that you find that there is a chance for loss. So, this is why actually we are recording provision for debtors, isn't it? We are making provision for bad debt, provision for doubtful debt. Why we are making such provisions? We find that there is a chance that these good debt become bad debt. So, in such case, in order to prevent that, in order to prevent the loss from such a debt, we are actually creating provision for doubtful debt and provision for bad debt. Okay. So, that is why we are creating this provision, is actually based on this concept, that is conservatism concept or prudence concept. Okay. Now, another concept is materiality concept. This concept says that you have to record only those transactions which has a material value, which facts are material. So, what is this materiality? So, this materiality is actually based on its nature and the amount involved in a transaction. That is, you have to check the amount and the nature of each and every transaction, and this nature and the amount determines whether a transaction is material or immaterial. Okay. So, any fact should be considered as a material. So, when a transaction is considered to be material, if it is reasonably believed that its knowledge would influence the decision of informed user, if it has such a power on decision making system, then you have to consider that thing, that particular fact or that particular transaction as material. Okay. So, the materiality is mainly depends upon the nature and the size of amount involved, and also is about the capacity or the importance of it is on making decisions. Okay. Now, here we have, when amount involved in is very small, strict compliance to accounting principle is not required. When we already said that actually if huge amount is involved, or the amount of involvement in a transaction is considered in order to declare that whether a transaction is material or immaterial. So, if the transaction include very small amount, it is not considered as immaterial, it is just immaterial. That is mainly about stock of errors, pencils, these all include a low amount. Okay. So, there is no need to consider it as material. Okay. That is actually given here. So, what is material? Here is an example. Money spent on creation of additional capacity of the theatre would be material fact, as it is going to increase the future earning capacity of the business. So, some amount is invested in theatre in order to make some additional capacity. Okay, maybe they are using more, maybe they are putting some investment in order to have more seating arrangements or more seats. Okay, in such a case that actually they are increasing their capacity. Okay, that will in future it will result in a high earning capacity, or that will build their earning capacity for the future period. So, this one is a material fact. Okay, but we are thinking about a stock of errors, pencils, these all involves very low amount. Okay. So, that such things are not considered as material, it is immaterial, but in this example actually they are investing to increase the earning capacity of the theatre in future period. So, that is very material. Okay. That is a very important area of that particular business. Okay. Now, the next and the last and very important concept is full disclosure concept. Full disclosure concept says that every material things or every things that is related to a particular transactions in a business have to be disclosed to both stakeholders and shareholders, because it is very important for them to take a better decisions. Okay, whether they have to know about more about the profits or losses that the concern earned. Okay, so it is very important that they should be aware, they should have the knowledge with about their business. So, all material and relevant facts concerning financial performance of an enterprise must be fully and completely disclosed in the financial statements. So, everything related to that particular transaction or particular happenings in the business, if it is a very important thing, it has to be communicated with the stakeholders and shareholders. It is very important that they have, because they have the right to know about this. Okay, so it is their right, so we have to protect their right. So, actually full disclosure is essential. Okay. So, why? that we already discussed. Even though this is to enable the user to make correct assessment about the profitability and financial soundness of the enterprise and help them to make better decision. In order to take better decision, they should be well aware about the things that is happening in the enterprise. Okay, so this is why actually a firm should not show some overstatement of profits or understatement of loss. This is not at all allowable. Okay, so they should provide a very good knowledge relating to their business to those people who wants to take decisions based on this. Okay, so now we can discuss about this question. Okay, that is asked in December 2015. Dual aspect concept results in which of the following accounting equations, and here 4 equations were given. We already discussed about dual aspect concept. What is this dual aspect concept? Every transaction has a dual effect or a debit and credit effect. So, okay, so it will have a debit effect and credit effect. So, here the first equation is revenue is equal to expense. We were not discussing about anything about this revenue and expense. Okay, the next one is capital plus profit is equal to asset plus expense. That equation is meaningless. Now coming to the third one, capital plus liability is equal to asset. So we know that think about balance sheet. Okay, in balance sheet on the one side we are recording capital and liability, and the other side we are making assets. Okay, and we discussed about an example, that is a particular person, the owner is investing an amount in his business. So that amount, that is 5 lakh, okay, if he investing rupees 5 lakh in his business, actually this 5 lakh is we know it is an asset, that is cash. So cash got increased by rupees 5 lakh, and at the same time 5 lakh got increased in the liability side, that is regards to capital, because that 5 lakh is a capital. That whatever the amount is contributing by the owner to the business is a capital, because the business have to repay that amount to the owner. We know that they are different entities. Okay, so this equation actually saying about this dual aspect concept, that is capital plus liability is equal to asset. So these are the two sides of a balance sheet, isn't it? So any change happening to this area will also result in a change in this asset side also. Okay, that's why this balance sheet is always equal. Always they are tallying one, isn't it? So what is the reason? This is because on the both side, whenever there is a change happening in the liability side, the same change will happen in a asset side also. Okay, so this equation, that is answer C, is the correct answer based on this principle. Okay, that is option C. Okay, capital plus liability is equal to asset. Now the other question was asked in July 2018, and that was an assertion reasoning question. Assertion: personal transaction of the owner of the business are not recorded in the books. So what all are the personal transaction? The transaction related to that particular owner. Okay, his personal transaction, that is he goes to buy some washing machine or what all the things he needs for his household purpose. It should not find a place in the accounts. Why? We know that the business and the owner, they are two separate legal entity. Okay, the business is a separate entity and the person, that is the owner, is also a separate legal entity. So the personal transaction relating to that owner need not find a place in that accounts of books. Okay. So that is, the personal transaction will never find a place in the books of accounts of business, because business and the person are different one. Okay. Now, what is the reason given here? According to the business entity concept, each business enterprise is considered as an accounting unit separate from this owner. So actually the reason is correct, that is why we are not recording this personal transaction is actually because of a business entity concept, that is business and the owner, they are separated legal entity. That is actually seen here, that is each business enterprise is considered as an accounting unit separate from its owner and the business unit, both of them are different. Okay, so actually the reason is also supporting the assertion. So here we have different options. So both A and R are correct, and we know that the why we are not recording the personal transaction, it is because of the business entity concept that we have already discussed. So A and R are true, and this is the correct reasoning of the assertion. Okay, so which is the correct option? Both A and R are correct, and R is the correct explanation. Yes, option A itself is correct. Both of these are correct, and R is the correct explanation of assertion. So this is all about the business, accounting principles. So we already studied about the different classification of accounting principle, that is accounting convention and accounting concepts. We discussed about each of them very clearly, and these types of questions were asked continuously from this area. So it is very important to have a thorough knowledge of these areas. So this is about the topic. Thank you.